we had some inputs, and we kind of understand what those new exposure draft will look like. So we'll talk about that as well. So retrospective application, as I said, from an 8 years perspective, no change. It's going to be same as what has happened in the last 25 years, pretty much. But it has a big impact that it has now legislative support in the Income Tax Act to do what they were previously doing, which previously could have been only arguable views of whether treaty provides that separate power, but it's a legislated now, so it's strong backing. So in Income Tax Act, we now have 3 provisions, Division 13, retrospective rules, which is under subdivision 815A, and Treaty Article 9. And what we believe is if transfer pricing adjustment is made in the future, ATU will apply all 3 sets of provisions, so there is no argument whether this rules will apply or this rule will apply. It will apply all 3 of those. The outcome from all 3 of those should be not different. It should be the same. In transfer pricing rules previously, it's not surprising. We haven't heard tax office saying to any taxpayer, you paid too much of tax, we'll refund you tax. No, you don't expect a tax office to say that. And so the power of the commissioner under transfer pricing rule is to just increase the adjustment to increase the amount of tax. They don't have power to reduce the profits and therefore refund the tax. It's just not there in the rules, which is not surprising. I mean, it's most of the countries, these are the rules. With regards to penalties, there are penalties if the transfer pricing adjustments are made to increase the amount of tax payable. I mean, because the government has lost the tax, and therefore there's an interest aspect of that time period for which the money has not been with the government, and also penalties for not getting it right in the first instance. So penalties are there. Very harsh penalties, 50% of the amount of adjustment made if the adjustments are a result of a scheme to avoid tax. It goes down to 25% if there's no scheme, but there's a genuine non-arm's length pricing and the taxpayer couldn't support it, which is like SNF case. And it could reduce further if there's a RAP, if taxpayer has a RAP. RAP means reasonably arguable position. So if taxpayer is able to demonstrate that we had this documentation, we genuinely believed what we price our products at were arm's length, and we got reasons and rationale for that, then the level of penalties then reduces. But with the retrospective application, we do not expect the application of penalty to change. It will be as it was under the old transfer pricing rules. Something is missing here. All right, I'm going to last slide. Prospective legislation, which is where government Treasury just released exposure draft yesterday for consultation. So we got a time of a month to involve in the consultation process with the Treasury. The last date is 20th of December. Treasury has invited professional services firms like us and also taxpayers, multinational companies to give their views on what they think about the new reforms and rules. So happy for any one of you all to kind of let us know if they've got any views and want to make any submissions. We're happy to coordinate with the tax office on that. So what the new proposed rules will look like, self-assessment regime, currently under Division 13, the way it works is Commissioner makes a determination of the arm's length pricing. Australian Income Tax Act works on self-assessment regime, but that was introduced sometime in 86, 87, whereas transfer pricing rules were introduced before that. So what they're trying to now do is apply self-assessment regime consistently to transfer pricing law as well. So taxpayers will have to self-assess their taxable profits based on the self-assessment, and then Commissioner will have to determine whether is that an arm's length outcome. Currently, there is no statutory requirement for taxpayers to prepare transfer pricing documentation. Now, what is documentation? This question comes up all the time. What is documentation? What are we talking about? We always have documentation. We have agreements. We have got invoices. We have got ledgers. Yeah, we have documentation all the time. No, I mean, transfer pricing rules clearly articulate in its guidance what documentation requirements are. It has a proper structured process, and ATO expects taxpayer to have the documentation in the event of a review or an audit. As I said, there is no statutory requirement or mandatory requirement to prepare the documentation. I understand India is one of those countries where you require mandatory documentation every year. I understand the penalties have not been applied as it was expected when the rules were introduced. But in Australia, it's recommendatory. So but we were expecting that with the reform, the rules may become mandatory. And we, through the consultation process, suggested that it's not a great idea to have mandatory documentation. It just increases that level of compliance for taxpayers. So we're seeing the exposure draft. It's not a mandatory documentation requirement. There's a requirement to prepare contemporaneous documentation. What does that mean? That when, as a public officer, a multinational company lodges its income tax return every year, a public officer signs on the tax return saying the disclosure are correct. And that disclosure requires that you have a transfer pricing documentation, okay? Which is basically explaining whole set of criteria, satisfying whole set of criteria. And I'll briefly touch upon what documentation is, but let's kind of go through this. The new rules require that that there may be some penalties. So currently, the documentation requirements are not linked with the penalty regime. The new rules are going to link that. So if you don't have documentation and ATO proposes adjustments, the penalty will kick in to determine what should be its 50%, 25% or lower rate of penalties. Time limits, imposition of time limits. Currently, there's no statute of limitation in Australia. Okay? On income tax matters, the 4-year statute of limitation. So you can't go beyond 4 years to make adjustments. Record retention period in Australia is 7 years. Okay. Transfer pricing, ATO commissioner can go back as many years as they want. Okay. There's no statute of limitation. And we have seen cases where ATO has times gone back to, well, 15 years, 10 years. I mean, it depends. What do they really see there as a concern in terms of loss of tax revenue from an Australian perspective? But there's no statute of limitation. Good news is that the new reforms restricts that time period to 8 years. Okay? And why 8 years and why not 7 years? Record retention period 7 years. Why not 4 years, which is income tax statute of limitation? And then this is something that we have been kind of submitting to the Treasury. I mean, saying that with the new reforms, new disclosure requirements, which I'll touch upon, ATO has got everything that they need to know to make a fair judgment on whether there isn't a risk of revenue to the tax office. So then why double the time when you compare it with income tax? But it seems it's not gone down, so we'll have 8 years for the time being, until the legislation is enacted. We'll have an introduction of an express reconstruction rule. What does that mean? OECD in its new guidance have reconstruction, has suggested that tax authority should have some reconstruction power, but it does say that that should be applied only in an exceptional circumstances. But ATO has gone a bit far from that OECD guidance. So what does that reconstruction power mean? So reconstruction power is, let me give you an example. ATO would not only have a right to make adjustment to cross-border transaction, which is purchase of product or a sale of product between related party, but it could construct a transaction. Okay, it could actually construct a hypothetical transaction. What does it mean? If you go back to SNF case, which we spoke about, where ATO argued that 11 years of operating losses, okay, not pay tax for 11 years. Taxpayer argued that pricing was fine, ATO in the decision impact statement did argue the point, which I'm just about to say, is that while they made losses, the reason why they made losses here is because just by being present in Australia, SNF benefited the French counterpart. There's a benefit that was provided to the parent company because of consistently operating here and making those sales to customers. So there was a benefit that Australia provided to its counterparts in overseas jurisdiction. And if there's a benefit provided, then there's perhaps a service provided. And because there was a service provided, there should be remuneration for that service provided. Okay. 11 years of operating losses. Argument is benefit provided to parent companies as a result of operation, and that benefit should result into a compensation. And that's the construction of a service fee transaction. Now that's the power that ATO is seeking through this exposure draft. So wide powers, extremely wide powers. Again, we're submitting, ATO should try and keep that reform process and the rules consistent to the OECD guidance, which is what they're trying to do. They're trying to bring transfer pricing law in accordance with the global transfer pricing rules. So if it's OECD rules, then they should follow the OECD rules, which is one of the submission. Arm's length principle, I said it's proposed that the arm's length rule should be consistent with the OECD guidance. What I haven't mentioned here is treatment of financial transaction, financial arrangements. ATO has released a ruling in 2010 where they talk about pricing of financial arrangements like intercompany debt, guarantee fees, and how the ATO would go about pricing of those transactions. ATO has argued what they call as commercial realistic outcome there, which means that if you go back to a previous example, slides are not helping me here, but if you go back to previous example where assuming that you had a gross profit margin, you had operating expenses, instead of loss, assume that you had a profit, operating profit, okay, which is before interest and tax. Now, after operating profit, say this company had a debt arrangement with a counterpart where they had borrowed funds, and therefore there was interest expense kicking in after operating profit. And as a result of that interest expense, there was a loss. So the argument there would be that, well, because we have made operating profit, purchase of product pricing is fine. But because of interest, there's a loss. So typically what you would do is you would then say, well, I'll explain you why there is an interest expense and the pricing of that interest expense. Arm's length nature of interest rate applied on that debt arrangement. ATO has in its rulings, which has been adopted in the new rules, is ATO is looking for a commercial realistic outcome, which is creation of profits after interest. Okay? And the argument is that level of borrowing make commercial sense? Does it make business sense? You have perhaps borrowed money from your debt because you are part of multinational group. Would you have borrowed the same amount of money if you were operating as an independent company? If you're an independent company, you would have perhaps not borrowed that money to the extent that you would have made losses. You would manage that. So what's an arm's length capital structure? So ATO is going into that area, and that's what has been or is been adopted in the new rules. So that's the broad indication of what the retrospective rules and the prospective rules will look like. The retrospective rules will have an application up until the proposed rules are enacted, and Division 13 will be repealed once the prospective rules are enacted in the transfer pricing law. Just mindful of time here, it's between the lunch. I'm just trying to manage that. The lunchtime is not delayed here. So international dealings schedule. Earlier in the year, ATO released a new income tax schedule It's called International Dealings Schedule, which replaces your current income tax return, Schedule 25A, which some of you may have filled as part of your income tax return, and consolidates the other aspects of tax return, which is thin capitalization schedule and CFC, and it consolidates into one. It was trialed with the financial service industry in 2010, optional, and 2011 it became mandatory for financial services industry. The ATA used that as a pilot program, which was finally introduced as a mandatory form that needs to be lodged by all taxpayers who lodges their income tax return from 1st of July 2012. The trigger point is that you need to have your cross-border international related party transaction equal to or in excess of $2 million. Okay? It's not a big threshold, it's kind of very small level of threshold there. And it's not only items that hit your profit and loss account, it also includes your loan balances. So if you have no other transaction but have 2 million opening and closing balance, it will trigger a requirement to fill up this form. Previous form, which is Schedule 25A, was a great form in the sense that it's two-pager form. Just need to make disclosure on the values of transaction, different types of transaction on one page. Second page, well, we have some documentation. Didn't matter for which transaction we have that documentation. Just make a disclosure there. No one is able to figure out how to link. Now it's changed. Change is that ATA requires information on the level of documentation that taxpayer maintain for each transaction. For each transaction, Schedule 25A had 8 questions to answer. Okay? 8 questions. International Dealing Schedule has got 18 questions to answer, and each question has sub-questions. 8 to 10 sub-questions within each of questions. So from 8 questions, roughly around 80, 90 questions to be reported on this form. I mean, it's an exercise by itself. Imagine a big bank who needs to extract that level of information from the system. They're not geared up to get this information. Just to give you another example on services, like if you're part of a multinational group, you don't have service agreement for 10 different types of services or support services that parent company provides. You've got one agreement, right? Which in the appendix then illustrates marketing support, legal support, IT, and rest of them. And what a subsidiary receives is perhaps 1 or 2 invoices during the year saying service charge, X amount. It's great because you disclose that amount on the form. They're saying, no, we're not happy with that. How about you split the amount by each category of service that you received from your parent company, and tell us what level of documentation you have for each of that split category. It's a lot of compliance work. Loans, for example, earlier it was opening and closing balance. If you had 10 different types of loans, just disclose balance on 1st of January and 31st of December. It is saying, we're not happy with that. Taxpayers, they borrow on 2nd of January and repay on 30th of December. No need to disclose opening and closing balance. So what we want is now quarterly balance. Quarterly balance, average quarterly balance. So it means that for the same loan, what you need to get information is, you need information on 1st of January, for example, 31st of March, 30th of June, 30th September, and 31st December. Get that amount, divide by 5, and that's a disclosure, right? If you're talking about big bank, I mean, how are you going to capture that information? It's a big exercise. It's a huge compliance effort. As a potential implication, use time involved, accounting data. What does that mean? Well, you're giving on a platter to the ATO, please come and review us and come and audit us, essentially, which previously was not readily available information. It's very specific, targeted information, makes a hell lot of easy to identify taxpayers with risk. Transfer pricing review and audit process. So what we discussed so far is what are new rules. where is ATO going with the new rules, what has it been historically. This section is more of taking you into within the ATO's processes, how does it all work within the ATO. So this is an overview of a transfer pricing review process. So once an income tax return is lodged with the relevant information to the tax office runs what they call as very sophisticated risk engine. Okay? Risk engine being something that they use all the time to identify taxpayers with risk, where ATO believes tax is at risk. Okay? And last few years they've also introduced what is called as risk differentiation framework, which got 4 quadrants. First quadrant being taxpayers with higher risk, where high amount of tax is at stake. Using risk engine, ATO then categorizes taxpayers by high risk to a low risk taxpayer. And then depending on which quadrant the taxpayer is placed, they'll then determine what response they need to give to taxpayers within each quadrant. So if you're in quadrant 1, high risk, it'll be an online, real-time review process. If you're in quadrant 2, for example, it'll be a periodical review process. Quadrant 3 or 4 are kind of medium to low risk, so they're happy corporate citizens. You don't need to review them, maybe perhaps 3-4 year once, knock on the door and see what's happening. So that's the process. So once you've been identified high-risk taxpayer, ATO would pick you up for a review or pick the company up for a review, and that will trigger this issue of a questionnaire. Okay? And questionnaire will request list of information, request to submit that documentation in 28 days. Following on with that, we'll potential one-on-one meeting to understand what's going on, to hear directly from the company, and then they will do an assessment. Assessment will be on what you submitted in terms of documentation, and as the theme has been for today, profit performance. So that's the assessment level, and the outcome will be, well, we're happy with you. We understand where you're going with this. Your results are fine. We'll let you go. It doesn't happen normally. It doesn't happen normally because the risk assessment engine is to identify taxpayers where there is a risk. But ATO is quite pragmatic in their approach. So if they really believe that the risk is not there, they have walked away from many review processes. There could be taxpayers where ATO is saying, yeah, there's something there, but we don't know what. Not sure whether they should invest their resources into the audit of the taxpayer. So those are the taxpayers. They are kind of put on hold. We'll monitor your performance for further few more years to determine whether really there's a risk. The last ones are, no, we're going to audit you. We're going to audit you, and it's a lengthy process. It's 18 months, 2 years process, and as I said, kind of go back as many years as the ATO wants or commissioner wishes to, depending on the risk involved. Next slide. What the next slide is. All right. So this is like an outcome of a review process. So we've got 2 steps here. One is review and second is audit. So this is what an outcome of a review process will look like. So the first part here is the quality rating on the documentation that is submitted. It's kind of 1 to 5, and this is a score on the financial performance of the company. So if you get a rating of A, so the rating goes from A, B, and C on financial performance. So if it's A, it's great result, it's consistent profits, no concern, you're walking away. If it's B, it's not sure. Yeah, it's volatile, but it's normal. And if it's a C, which is consistent losses, that's where it's audit action, right? On the quality of documentation, it's a structured documentation process. As I said before, step 1 to step 4, ATO will go through the checklist, tick what has been covered in the documentation vis-a-vis what you suggested or recommended taxpayer should have. But that's a rating, and depending on what is in the documentation, you get a quality rating from 1 to 5, 3 being a median quality, 4 being a great quality. If you get 5, perhaps you're spending too much money on transfer pricing compliance. So if you get 3B, I'll say as a transfer pricing specialist, it's a great outcome. It's kind of a good balance between what you need to do with your compliance versus management of transfer pricing risk. Yeah, we spoke about risk engine. What are red flags? There are a few red flags that worth noting. First of all, loss-making entities. If you're a loss-making entity or low profitability, it's clear red flags. If you've got transactions like royalty payments, inbound or outbound, huge fluctuations in the royalty payments, there's something going on there. It kind of thinks they should investigate that further. Management charges, service charges, inbound and outbound, very low-hanging fruit for the ATO. It's like something that ATO would rock up and easily ask questions, where to hit the mark on service charge, very easy. So it's a red flag. Reporting on the international dealing schedule as to what the level of documentation taxpayers have got. That's one of the red flags. If it's a low disclosure of the level of documentation, it's clear taxpayer has no idea what's going on. So that's one of the red flags. And interest-free loans, well, if you have inbound interest-free loans, well, it's not a risk because you're not paying interest. It is happy because to that extent you're paying more tax. But if you've got outbound interest-free loans, it's a clear risk because then there's no interest, corresponding interest income on which you pay tax. So those are the risks. The other areas which notice are business restructuring. The ATO has issued detailed guidance on business restructuring and what they expect taxpayers to generally cover and maintain to support the rationale behind the restructuring. When we talk about business restructuring, from transfer pricing perspective, we talk about changes in the activities performed in the local entity, underlying assets used, and the risk assumed that Subbu mentioned previously, and whether those combination of all of three has been shifted overseas or have been shifted from overseas into Australia between related parties, and what impact it has on the profitability, the commercial rationale for that, and that's the business restructuring from transfer pricing perspective. So we've covered quite a bit in terms of risk areas. Mindful, we have some time for questions. So in conclusion, it's the biggest change in 30 years, brings a lot of uncertainty and risk for taxpayers. Australian multinational operating in Australia. Practical implication, the rules go back 1st July 2004. ATO still kept the power to go back and make adjustments based on profits. So with retrospective application, the three areas that ATO will focus on, which is low profits, business restructure, and financing transactions, high interest, highly geared companies. That's the three focus areas. So if your facts and features reflect those characteristics in your business going back to 1st July 2000.